Woohoo, here we go. We are on the home stretch, I think we'd call that. Last several weeks of class here. We've made it through spring break. I hope everybody had a great time. I hope you all got to go golfing and skiing and other activities like I did. Had a good time in the weather. I mean, could we have asked for nicer weather in north central Montana for spring break? Why the heck would anybody want to go south or do anything goofy like that when you could have enjoyed perfect weather up here? In fact, I talked to my mother in Yuma, and she was complaining that it was far too hot down there. So good for them. Yeah, no, we enjoy it up here, and to heck with that hot weather. So I would have liked to have had a little more snow out in the mountains. At least skiing would have been a little nicer. I think our ski hill, like apparently many others, have had to close down here a little early because of the lack of snow and the warm temperatures. But oh well. We just dust off the golf clubs and go at a different sport. So, all right, here we are. We are up to chapter, the heck, is it chapter 10? Yeah, 9. We did all that stuff. Man, oh man. I spent a decent amount of time on that because that's stuff that I used every day, and not just once a day. In my banking career, I used chapter 9 stuff every day. I don't know, 5 times a day up to 20 times a day. There was probably days when I used it 50 times a day, and honestly I did a lot of it on a calculator as opposed to Excel. Excel wasn't as highly developed back then as it is today. Would have been one reason, but two, I'd become a pretty adept at doing a lot of those problems on the calculator. I find today, after having worked with it, that Excel works pretty good. It may not be as portable, although versions of Excel are coming out, and you guys are real mobile. No doubt you can have versions of Excel or similar products where you probably be able to do those things on your mobile phone, which is pretty cool. So hope you enjoy that. Here we go. We starting here March 16th, so we are chapter 10. Your assignment, I think I have up here, you guys have 1, 3, 6, 8, 14, 17, and 30. A lot of what we're going to talk about is bonds. Most people don't think about investing in bonds other than maybe some leftover money that they might have or whatnot, but there's a whole industry devoted to that. People buy and sell bonds all the time. We at the bank often had to invest in bonds. If as a bank, you've got a lot of deposits or that people bring in, if you're unable to lend them all out, and in fact, it's difficult to lend them all out, and the government doesn't like you to lend out every single dollar of deposits. They'd like you to be a little less than fully lent out. You really have to invest that money in bonds, and you have to have a little bit of the knowledge of some of the things that we're going to go over to understand how bonds work. One of the main things is this. We often think, for example, if you went down to the bank and you bought a CD for $1,000, you put $1,000 into a CD that was going to mature in 5 years, there's no way you can lose money on that, right? Maybe you get 3% interest, okay? And in a sense, that's very true. But what happens, let's talk about that though. So in that 5-year period of time, let's say in year 2, interest rates go up to 7%, and you're only earning 3%. How do you feel about the value of your CD? It's kind of like, ouch, somebody that has $1,000 a year from now, they're going to get 7% per year or $70 a year in interest, and you're only getting $30 a year in interest. They're going to make more in the remaining 4 years than you'll make in your total 5 years, okay? And so technically what has happened is that the value of your CD has gone down, okay? You're still going to get the $1,000 at the end, yeah. If you hang on to it, that's very true, okay? But we're going to talk about bonds because people don't necessarily hang on to bonds till maturity. The bank would purchase bonds, but what would happen if next week a bunch of customers came in and wanted to borrow money? We might have to sell those bonds, right? So we're very concerned about how the value of those might change. Okay, in general, think of this too, and keep this in mind as you're doing your problems. It'll really help you catch some issues that you might have with individual problems. But if interest rates in the marketplace have gone up, the value of the bond will go down. Okay, and the opposite if true. If interest rates in the marketplace have gone down, the value of that bond will go up. Okay, go back to that example that I gave of your CD, that you might have a 5-year CD, right? And you put it in for 3%, but rates went up to 7%, right? Okay, what's the value of your CD at 3% when rates in the marketplace are now 7%? It's probably less than the $1,000 that you put in. And we're going to do a lot of calculating on that, but that's a basic principle that I really want you to understand. And when we go through some of these problems, you should be able to ahead of time, just glance at them and say, ooh, well, that should go down. Okay, and if we get a good answer, or an answer that kind of fits that guess, we might be more confident that we're correct. So let's take a look at some of these. I can make this even bigger. We'll start. You guys have to do problems 1 and I got all these 1 and 3 and 6, 8, 14, 17, and 30. So I'm going to take a look at problem 2. And problem 2 says this. Let me get my book out here. It's just a basic one. A lot of the first ones are pretty basic. We just talk about what happens to the value of certain bonds. And problem 2 says Midland Oil has a $1,000 par bond outstanding at 8% interest. So I'm going to enter in my stuff like this. My par value is 1,000, and 1,000 is going to be pretty common with our problems. I think in the industry, 10,000 is probably a little bit more common. But the bonds will mature in 25 years. So I got my number of periods. It's 25 years. Okay. Outstanding at 8% interest. Now I did this. Okay. I put my 8% over here, and I just entered it in as 0.08, and I can make that into a percent. Okay. And I did that because of this, because I also need to calculate then what my yield is. And what my yield is, and you can do this in your head, that's fine, okay, but I want to show you how to do it. Your yield is, if you've got a bond with a par value of $1,000 and it's paying 8% interest, they're going to pay you that interest probably every year. Some pay it semi-annually, some pay it quarterly, some pay it annually, right? Most of our problems that we're going to work on now are going to be just based on an annual payment of that, okay? So 8% of 1,000 is $80, right? I could do that in my head, or I can have it here, and I can just say this is equal to my 8% times my $1,000. Okay, so I get an $80 because that's a payment actually that I receive, and I might even put that in here and say yield, slash, oops, got to type here, payment. Okay, because when we do our formula, we're going to kind of need to know that, and then it gives me 3 different scenarios. It says compute the current price of the bonds if the present yield to maturity is 7%. Is A, and 10% if it's B, and 13% if it's C. Okay, so I labeled this market rate and I put that in there, 7%, 0.07. Okay, and I can change that to a percent if I want. Now again, let's go back to my basic theory there. My basic premise was, what happens then if I've got a bond and I'm getting paid 8% on it, or $80, but the current market rate, if I was to go out now and purchase a bond or invest in a bond, I can only get 7%. Ooh, well, I might be willing to pay a little bit more for this bond than that's going to pay me 8%. I'm going to get $80 per year here. I'd only get $70 per year here. So definitely I'd be willing to pay more, right? And so the value that I'm looking for is going to be something higher than that par value, okay? So let's take a look at the formula. This is one of those cases where it's very similar to the ones that we did last chapter, but we've added a fourth variable, okay? This becomes more important for us too, to get the pluses and the minuses kind of correct, which is a little bit confusing at times, and I'll tell you how I do it, and it's not necessarily perfect, okay? So I'm solving for the present value. That's what I want to know. It says what is compute the current price of the bonds, or the present value then of the bonds, assuming those different yields to maturity, or the different market rates, okay? So my rate that I have, that's where I put in this market rate, okay? That's the current rate that things are going for right now. My number of periods I can put in as this, okay? My payment is in fact this yield, or this payment that I'm going to get here, right? My $80 per year that I'm going to get in interest. And I might want to enter that as a negative number. Now, again, think about money that, oh, you know what? I'm not going to enter that as a negative, okay? Because I want money that's going to be leaving my pocket to be a negative, right? I want the money that's going to be leaving my pocket to be a negative. I'm in fact going to get $80 per year, and I'm going to get then my future value up here. I'm going to get $1,000 in the future, okay? So I'm going to get $80 per year for 25 years, and I'm going to get $1,000 in the future. I already know that my present value ought to be bigger than my par value because rates have gone down. Rates go down, it's kind of an inverse thing. Rates go down, the value of the bond goes up, okay? In this case, it comes out as a negative, and it makes it look like the value's gone down. It hasn't, okay? So I'm going to pay $1,116.54. So I am going to pay $116.54 more than the par value of that bond, okay? It's in red numbers because to me that's what would be leaving my pocket. That's what I'd be paying for it. If we did this, and this would be fine, okay? I'm certainly not going to mark you wrong. If you came up here and you said your payment was a negative, you'd also have to make sure that your future value was a negative, right? We'd get the same answer. It would just be a positive number then. And I don't care which way that you do that necessarily, just so you come up with the correct answer. You know, what would happen if you had one of them as a positive? Let's say okay. Now this gets back to, okay, I know that that's a wrong answer because that amount, 748, is less than that, and I already knew that it should be greater than that. That it should be greater than the $1,000. So that kind of points that out, you know, what you want to look for before you do these problems. Okay, now it goes on and it has 10% and 13%. And if I were doing these, I would copy, you know, this whole field here, and this would be A. I'd call this 2A, and I'd just paste it down here 2B. My shortcut's going to be this to show you guys. I can simply change this, and you could certainly, you know, build your formula like this, and if you wanted to put the answers down below here after you calculate them, that would be fine. Now in this case, market rates have gone up. So what am I going to assume is the value of the bond, or the present value of the bond? I have to assume market rates have gone up. The present value of the bond should be less than the par value. So let's enter that and see what happens. There we go. Yep. $182 less than, and it should go down even more than when I plug in 13%, because rates have gone up a lot. This old 8% bond just isn't worth much compared to this 13% bond that I could get in today's day and age. So how much is it worth? $633.50. So those all make sense, right? They went down just as I predicted, and so that's the important part. If you can kind of be a little bit predictive, you can't really of the dollar amount, but you can sure know which way it should go. Let's go on to 5. You guys have 3, and I think this first one should have helped you with 3 because it's basically the same. We'll go to 5. You guys have 6 also, and so we're just kind of doing some in here that are pretty similar. 5, we'll set it up much the same way. It says Essex Biochemical has a $1,000 par value bond outstanding that pays 15%. Okay, so I got $1,000 par value. I got my 15% in over here. Okay, plug that in. The current yield to maturity on such bonds in the market is 17%. So the current market rate is 17%. Wow. Okay. What percent? Oops, I'm sorry. Compute the price of the bonds for these maturity dates. So we're just changing the maturity dates here now. Instead of changing the market rates like we did on number 2, we're going to be changing the maturity dates. And as you can see, I kind of went through and did them all. I ended up on the last one, but again, if I put my formula in correctly, I got my par value. I enter that. I got my number of periods. I enter that. My yield is again just simply equal to my rate, the original rate of the bond times the par value. Okay, and my market rate is what's going on, and that's going to stay constant here. The one that's going to change here is the number of periods. Now, but let's again talk about it. So the yield is 15. Interest rates in the marketplace have gone up, so the value of the bond should be less than the par value, right? It's only 2% difference, so it's not huge, okay? And especially, you know, I'm on 4 years there. This difference should get bigger, though, right? That 2% is going to be more meaningful over a lengthier period of time, so it's going to get bigger as the years get bigger, right? Okay, so I put it in. I could actually, right? It's the same formula. I could copy this and paste it here. It's just the same formula, right? Okay, and I can change my 30 years, right? Okay, now the difference should get, this should be the biggest difference, okay? And then I'll go 20 years, and that should get a little closer to 1,000, right? A little bit closer. Did not much, right? So there's not a lot of difference. Let's go back and look at that. Not a lot of difference. That's 883, and then over 20 years it goes up to 887. So we got a little bit closer, but not much. It should take a little bigger jump now, right? When we go down to 4 years, because we're not talking about too many years. Okay, so it took a pretty good jump. Okay, and those make sense. Again, it's less than that, which is what I would expect. So. Okay, moving onward. You guys have number 8, I believe, 6, but I think the one that I just did should help you with 6. Yeah, that's just changing the years. Okay, it's all the same formula. You're just kind of changing the years and stuff a little bit. So you guys have 8, and 8 says go to table 10.1, which is on page, I'll go back, it's kind of towards the front of the chapter. It's on page 305. Okay. So you go to page 10.1, and that talks about a bond that's paying 10% interest for 20 years. And for year 8, it says assume interest rates in the market yield to maturity decline from 11% to 8%. Now I did number 9, and 9 is just the opposite because I'm assuming that the yield to maturity increased from 9% to 12%. Well, first I have to set up the bond, and if I look at the chart on 10.1, table 10.1, my par value is 1,000, just like that. It's a 20-year bond. It tells me that both in my question for number 8 and also back on the deal. So my yield is the 10% or 0.10, right? And so this is equal to $100, my 10% times my 1,000. Okay. But my market rate is going from 9% to 12%. Okay, so I have to do a couple of things. Again, if the yield was 10% and rates go down, the value of my bond should be greater than the par value. Okay, because they went down 0.1%. Okay. On the other hand, if my yield or the market rate goes up, it should be worth less. Okay, and that's all this is trying to tell you. It's trying to show you that capital gain or loss that you might get. Okay, if you had a situation like this, you're going to have a capital gain or a capital loss, right? Okay, if you purchased it at one and sold it at another. Okay, so in my case, it says for number 9, it says what's the bond price at 9%? Okay, and I know that since rates went down, the value should go up. So I just do my present value. Okay, I'm going to just hit delete and I'll put in my present value calculation. Okay, my rate is the market rate. Okay, my number of periods is my 20 years. My payment is my $100, and my future value is going to be that $1,000. And I'm going to put both those in as negatives just because in this case. Okay, so I got $1,091.29. The only reason I put both those in as negatives, I just want these to be the same, and I think it's a little bit easier if these are both positive values. They could both be negative values, and I could come up with the same answer. It's a little bit easier this way. So, okay, same thing here, right? I just run the same formula. I can't copy it because my references, it's be a little different. If I had used the dollar signs, I maybe could have copied it. So, but my market rate is this, my number of periods is that, my payment, I'll enter it in as a negative, and my future value also, I'm going to get that $1,000 in the future. Okay, so $850.61, that kind of fits, right? They both fit. So here's what happens. I bought it at this and I sold it at this. I lost, okay, $240.67. I actually lost that, and I should put that in there as a loss, right? Okay, and now I have to calculate, okay, and I should have this as a negative number, really, right? So what I really should do is say this is equal to this, what I sold it for, minus what I paid for it. Okay, I got to fix this formula then because I've got it properly entered as a loss. And oops. Sorry. Okay. So I have a loss of $240.67. Now I just have to compute what that loss is, okay? And so it's, I paid this for it, and so my loss is based on what the dollar amount that I lost compared to what I paid for it. So it should simply be, this is, oops, hit escape. I want to come down here, I'm sorry. This should be equal to my amount of my loss divided by what I paid for it. Okay, and I come up with a negative 22.05%. So I could take a huge loss, right? Just in that change of rates, and that's a good problem to really demonstrate that I can take a capital loss, okay, because of the way rates change, you know, and you watch that. Right now, there's a lot of interest going on in the financial world with exchange rates of currencies and whatnot. Very, very similar. You know, you do a lot of the calculations if you're investing in currencies, which to me get pretty complicated, and I don't think I'd ever invest in currencies because I don't understand them enough. But you do a lot of the calculations the same way. So, okay, so that should help you guys with your number 8. And then you have number 14. And 14, I don't think I had a good example. 14 gets a little bit confusing the way they set it up. I'm hoping I can make this a little bit easier, but I used one that I had already done. Really, all they're trying to do here is say, give you an idea of how we're calculating these and why we're calculating these. Okay, and so let's take a look. And for you guys, 14, it says Katy Perry fruits has a $1,000 20-year bond, let it current yield of 15%. Assume that the current market required interest rate on similar bonds is now only 12%. Okay, so let's see, the market rates went down, the value of the bond should go up then, right? Okay, but then it says compute the current price of the bond, so you could do that, and you will do that. Find the present value of 3%, so B then gets to be a little bit weird. Find the present value of 3% times 1,000, or $30, okay, for 20 years at 12%. Well, the 20 years is what the bond was, right? Yeah, okay. The $30 is assumed to be an annual payment. Add this value to the $1,000. What they're just saying is that we can calculate this by calculating the difference in the payment amounts, right? Okay, and I just used my one from number 1 up here, I think, what it was originally when this market rate was 0.07. And so I just did that, and my payment difference, let's enter the data. Your guys' is going to be different, obviously, but I got 1,000. Mine was 25 years, yours is 20. My yield was based on 8%, so it was $80. Okay, my market yield, though, on this one was 7%, which would be $70 then, right? Okay, that would be $70, and I calculated this present value of this bond, right? Okay, so my difference here is $80 is what this one would pay out, but the market rate difference, this would be a $70 if the par value was 1,000. Okay, so it's a $10 difference. So all it's asking you to do, okay, all it's asking you to do is calculate the present value of that payment stream. What's the present value? And that gets back to some of the things that we did in chapter 9. Okay, and in my case it's $10. In your case it's $30, and of course your years are different and those things, but I'll just come here and I'm calculating the present value of that payment stream. So my rate is, what the market rate is what I want to use. Okay. My number of periods, in my case is 25, in your guys' case is 20. And my payment then is a $10, which I'm going to enter as a negative, and that way I'll get a positive answer. And lo and behold, look at that, it's $116.54, which if I added it to the par value would give me also the present value. So it's just saying that you could use the payment streams as a method to calculate this, and then either add it to or subtract it from the par value. Don't make it, you're going to read that one and think it's kind of complicated. Don't make it any more complicated than what it is. Really, you're just finding the present value of $30 payment stream, right? Okay, which we've kind of done. So moving on, you guys have 17, and I don't think there wasn't a similar one, and so I just did 17, but I changed the numbers, of course, a little bit. 17 says this. Again, it kind of reads a little bit funky. Lance Winningham IV, wow, specializes in buying deep discount bonds. These represent bonds that are trading at well below par value. So what's that mean? That means that they're bonds that interest rates have probably gone up dramatically, right? And so the purchase price of the bonds, or the present value of the bonds, have probably gone down dramatically. Okay. He has his eye on a bond issued by Leisure Time Corp. The $1,000 par value bond pays 4% annual interest and has 18 years remaining. The current yield, so yeah, interest rates have really gone up, which has forced the price of the bond way down. Okay, and I did something similar. I think I even used the same number of years, but my par value is 1,000. I used the same number of years, but I said that the current is 5%. Okay, or not the current, I'm sorry, but the original, okay, the original yield on the $1,000 was 5%, and so again, that's 5% times my deal gives me what my payment is, my interest payment, and my yield to maturity then is the current yield in the marketplace, right? So again, rates have gone way up, the value of the bond has gone way down, and I can figure that by doing my present value, right? So I come come up here, I just click my present value, and I'm sorry I haven't gone to the financials and found it because it's the most recently used and it's the one that we use basically all the time for this, right? So I use my yield to maturity, I use my number of periods, my payment. Again, I'm going to go ahead and enter it in as a negative number, as I will with my future value, just so my outcome is a positive number. And we could do it the other way, and that would be fine. We could have this come out as a negative number. Should actually be more accurate, but that's okay. Okay, so there's my value of my bond, right? Current value, present value. My capital gain, or my gain, then could be over the rest, over that 18 years. Eventually I'm going to sell, or if I hang on to this, right? If I hang on to this, I'll get this $1,000 at the end of the 18 years, and that's kind of what it's saying here. So my gain would be then the $1,000 that I'm going to get minus what the present value of that is. So this is simply equal to my future value that I'll get minus the present value. Okay, that will be my gain. Okay, now how do I calculate? I calculate the percent of my gain. Remember up here I took my loss and I divided it by my original investment. In this case I've got a gain and I divide it by my investment, which would be what I'd pay for, which is this present value. So this is simply equal to my gain divided by my present value, or 120.8%. Okay, or I'd get 1.208, right? And I convert that to my interest rate. Now then, the next step, so again, it reads in a little bit more complicated than what it actually ought to be. So what is the annual compound rate of growth in the value of the bonds? It says an approximate answer is acceptable. You should be able to get an exact answer, and let me show you how. Okay, it wants you to calculate a rate. This is just like some of the problems that we did, again, from chapter 9. And all it's doing is it's asking you to determine what the compound growth rate, or the annual growth rate is, if you had a present value of $452.81 and a future value, this is actually your future value, of $1,000 over 18 years. You've got three variables. Your fourth one is going to be your solution, or your rate. Okay, so let's go solve for that. Okay, again, you could go to the financial, click on rate. Okay, and I've got my number of periods. My payment I don't have, but I do have a present value. It's asking you to, I should emphasize that in this case it's asking you what's the annual compound growth rate in the value of the bonds. So it's not asking you to include the payment amount in there. If you included the payment amount, you should come up with that 13%. That's the yield to maturity. Okay, so we're not really trying to back that in. What we're saying here is just what's the compound growth rate in just the value of the bonds. Okay, and so my present value is what I'm going to pay for it. So that's going to be a negative because that's the part that's leaving my pocket. My future value is going to be this par value. It's going to be what I receive in 18 years. Click on that, I end up getting a 4.5% compound growth rate. So, okay, I'd also get $50 a year. All right, last problem, number 30. I didn't do many of these, and the book has a decent number of these, and I'll tell you why I didn't do it. I'll have you do one just kind of for the sake of it, honestly, because this talks about trying to value a company's stock using a specific formula, and it has to do with growth rates of dividends and whatnot. I got to tell you, I've been watching the financial news. CNBC just celebrated its 25th anniversary, and I've probably been watching it 24 of those 25 years. Okay, and I watch other business channels as well, and I teach business, and I was in banking a little bit, and I've never heard or seen anybody use this formula to determine a value for a stock, okay, on any of those programs. And so I don't know that this has a lot of day-to-day value, and so we're going to do one kind of a whoop-de-doo thing, and go from there. I guess we'll test your math skills a little bit of your algebra skills. Again, there wasn't one exactly or similar, and so I just used the same one, but I just changed the number. So number 30 says Maxwell Communications paid a dividend of $3 last year. Over the next 12 months, the dividend is expected to grow at 8%, which is the constant growth rate for the firm, 8%. Okay, the new dividend after 12 months will represent D1, okay, or dividend 1. The required rate of return, K sub E, is 14%. Compute the price of the stock. Well, I used a little different. I just set up my labels. So my D1 is going to be, I said that my current dividend is $2, and my growth rate was 6%. Okay, so my D1 is going to be equal to $2. We'll just do the math. 2 times, right, 1.06. Okay, so $2.12 is what my dividend will be a year from now, because my growth rate of my dividends is 6%. Okay, and then my required rate of return, I used 12%. You guys have 14%. My growth rate, I already said, I'm using 6%. You guys have 8%. Yeah. Okay. So the formula, and it's kind of back here in the start of those blue pages. You can see it on page 320 towards the bottom for the common stock. There it says PO is equal to D1 over K minus G, and I put it in over here. So then it's just simple math, right? It's really just simple math. We'll just go, this is equal to my D1, okay, and divided by, and I'm going to need some parentheses because I got a minus, my required rate of return minus my growth rate. So my 12% minus my 6%. So this minus this, end parentheses, should be all I need to do. I click on her and I change it to $1, and I end up, the price of that stock ought to be $35.33. So I challenge any of you guys, go out and try to value a current stock using that formula and see if you come up with that answer. For one thing, most companies don't have a constant dividend growth rate. Dividends usually vary. You'll find some companies that have constantly increased their dividend, and bully for them, but that the growth rate of that increase is usually pretty variable. It just depends on how good or bad things have gone from year to year, right? Your required rate of return differs too based on circumstances. Rates are really low right now, okay, in the marketplace, and we as people might be pretty happy to get 4, 5, or 6% as a required rate of return. Growth rates are probably a lot smaller than 6%. They're probably more like 2 or 3%. Okay, but those variables are all going to change 5 years from now. And so, yeah, sorry, I shouldn't spend a whole lot of time telling you why I don't like the formula. Did the math. I guess it gives you some insight though into the financial world, and maybe things that we do or don't do when we're doing some of those calculations. So, okay, I think that's it. I think I've kind of got through the problems that should help you guys. So I did, somebody pointed out I wasn't very up to date on this stuff. I'm hoping now that I'm a little bit more up to date. This chapter 10, it doesn't say quiz, but I'm pretty sure that ought to be your quiz. Okay, I don't have the final week set up yet, and I'll get that, try to get that set up. Somebody had asked, geez, there's no assignments for week 13 or 14, and there might not be for week 15. What gives? I know that was an ultra motivated student that was interested in doing more assignments. When we get to chapters 13, 14, 15, we actually get away a little bit from the math side of finance. We get to talk about some of the other issues in finance, which I really enjoy. You probably, now here's the bad side, is you're probably going to listen to more of a regular lecture that might help you with the quiz. How's that? If you're confident that you can go ahead and do the quizzes and whatnot, yeah, okay, go ahead. The other thing is it might help you, and I'll probably spend some time talking about, or certainly I will, on Project 2. So there you go. Sunday we got finding financial information due. I think I better talk about finding financial information. Let's go up and see what we got going on there. I'm sorry, I about skipped right over that, so let's open that up and take a look. I think I might have already talked about that a little bit for those of you that wanted to get ahead. I think some of you have already maybe even submitted some of that, but let's take a look and talk about it briefly just in case. So it's some fairly basic financial information that I want you to look for at this point in time. I'm just trying to build on a few things to get you to the information that you will need for Project 2. Okay. And so let's take a look here. Let's make this quite a bit bigger. Okay, you know how to find stock quotes. Let's start out because we had you guys do that, right? You found the tickers, and then thus you can get the stock quotes. So this week I want you to report on the sales trend for the past 3 years, reporting the earnings per share trend for the past 3 years, report the most recent ROE, the most recent ROA. And then examine the company's most recent annual report. And we kind of talked about annual reports. Okay, it's okay to copy and paste much of this. Tell me what it does in the words of the management, right? Okay, so I think I said, and I still like this site, right? I still like Morningstar. Okay, so if I come here, or you go to your Google, whichever you use, and I bring up Morningstar. Okay, click on stocks, or I could click on the main page. I don't think it would matter. And I want to get a quote of a particular company. One that I'm interested in is a CHD. I like that. Maybe I've used this one before. But I just type that into the quote thing up here. I type in the ticker symbol that you guys have already found, right? Okay. And I've asked you to find a few things, okay? Okay, and guess what? What are those things? Let's go take a look again. I'm going to shrink it down a little bit so I can kind of compare it, okay? Report the sales trend for the past 3 years. So on my first page here, sales are equal to revenue, right? So I've gone, and kind of a little backwards here, but I've gone from 2012 to 13 to 14. My sales trend is that I've gone from 2.922 billion to 3.298 billion. You know what would be cool? I would like it then if you told me what that compound annual growth rate is, right? Present value, future value, 3 years. Okay, report the earnings per share trend for the past 3 years. I wonder if I can find that. Ooh, not exactly, not exactly. Oh yeah, sure I can. I'm sorry, it's right here. Again, okay, pretty simple then. From $2.45 up to 3.01. Again, wouldn't it be cool? I didn't ask for this, but wouldn't it be cool if you told me what the compound annual growth rate is? Present value, future value, 3 years, boom, should have it. The most recent ROE, okay, and label it this way if you're using Morningstar. Some of them might give you something a little bit different, but this is ROE TTM, which is trailing 12 months. Okay, so for this stock, it's for the trailing 12 months, it's 18.8. Can't get any more recent than that. ROA 9.6. It kind of compares it. This is the industry average, and so ooh, this stock's beating it a little bit on the ROE, quite a bit on the ROA. Okay, that should tell me, if I'm looking at that, if I'm analyzing that, I believe that would tell me that it has a little less debt, a little less leverage than the industry. Ooh, okay, that's kind of an interesting thing, and not a bad deal. So, okay, what else? ROE, ROA. We got examine the companies. Then you got to find their annual report. Okay, and again, I think that filings. Here, if you come down here and it says filings, I think if I go to financials, it might actually take me to something that says annual report, and I can get it probably right here. Okay, it's in English, that's a good deal. 12/31/14, so that's the most recent one. You might watch some companies, and you guys might have chosen some that don't have a year end that corresponds with the calendar year end. Okay, so you have to be careful. They might have a year end that was 9/30, and that might be their annual report. So go by what it says here, not by what the date is necessarily. So I want the annual report, and I can click on this, and hopefully it'll take me there. It doesn't tell me what that format is. Oops, I just clicked on it probably too many times. Now it's going to bring it up 14 times. Okay, annual report. There it is. This is in an HTML format, which is okay. I can probably still copy and paste stuff from here if I want. It'd be nice if I could get this into a PDF, and you can. If you look around, you'd be able to get this in a PDF, I'm sure. Okay, but still, you can come down, management discussion, management letter, management whatever. Okay, I just, here's what I want you to do is kind of read through it a little bit and get a little bit more comfortable, right? Here's in general, right? The company founded in 1846 develops, manufactures, and markets a broad range of household, personal, and specialty products, right? Bingo. Bingo. Okay. Focuses on consumer products, different things there that they do. So pretty cool, huh? Okay. So I could copy and paste a lot of that and put it in there. So I hope you get the understanding that I want you to open it up. I want you to look at it. You might want to, if you can get this, find it. I don't know if this is going to let me do it in a PDF. I wonder if I could save it as or whatever, but you might have to hunt around. You might have to go to the company's website and be able to get it in a PDF, and you might be able to save it, because you're going to come back and look at that annual report regularly, I would think, as the project goes on. You might even come back and look at former annual reports, but this is a quick and easy way to find it, to answer the questions that I've posed for this week, and just get kind of looking through it. Okay, you're going to need it. Read up on it a little bit. Maybe read what the company does that you picked. Okay, and then we'll advance that a little bit further. I think next week we'll start talking about your outline and whatnot. Okay, so I think that's it for the week. That's enough. 47 minutes. That's way more than enough. So I'm going to sign off, and I'm going to talk to you guys next week. And have a good week, and holler.